We have with us on the phone Michael Santoli of Yahoo Finance to talk more about this. There we see 331, 365. We're just seeing that number tumble. First of all, what exactly is it that investors should be thinking on a day like this when they watch the Dow and when they see what's going on in global markets happening?
Well, I think first off, people should recognize that this is, in some respects, kind of an overdue adjustment to stock prices. We have been, kind of going up for 6.5 years, and for much of this year, the U.S. stock market was really the only market in the world that was kind of calm and placid and shrugging off things like Greece and the nastiness in the Chinese market. So we had no adjustment to those things, and then all of a sudden it hit at once. And so it basically, the speed of this decline means you have to just, in a sense, step back and say, well, let's wait for this indiscriminate selling wave to hit the market. I mean, you really have no choice at this point. And then decide from a longer-term perspective if you would like to be an investor at today's prices, which are 90% of where they were a few days ago, or would you rather that they never did come down?
Right, Michael, it's difficult, I think, for investors when they see at the open today the market down already 735 points and many people scratching their heads wondering what they should do. But generally, most financial advisors, and I spoke to one over the weekend, caution that this is what in some cases are known as healthy corrections. After the market has been roaring up and up practically every week over the last couple of years, a correction like this does provide some breathing room for investors.
Well, it does. Now, the thing is, corrections would never happen if they weren't scary and they weren't accompanied by bad news. So even though you might have, in the abstract, 4 months ago say, boy, gee, I really love one of those 10% pullbacks to be able to buy more stocks and reallocate money into the market, when they're actually happening, it always seems like it could be much worse. And in fact, it could be much worse. We actually could be in for something significantly worse than this. If you look back at, for example, 2011, we had the euro debt and the debt ceiling scare. That actually brought the U.S. market down close to 20%. Right now, we're kind of going back to levels that were first reached, about a year and a half ago in the stock market. So it is unnerving. I'm not trying to diminish, the emotional element of it, but I think that we have to get back to a few kind of basic principles, which is there's rarely a prolonged downturn in the U.S. market if you don't have a U.S. recession. It does happen that you have these big shocks, but usually you don't have a deeper, prolonged meltdown unless there's something bigger going on with the economy. At this point, it doesn't quite seem that way. This seems like more of a kind of big global gut check for investors, much more of a financial market event domestically than it is an economic event. Hopefully that remains the case, but we have to see. And it also is really just a reflection of the fact that it's such a global world right now, and the world was over-reliant on China as the source of that extra bit of growth, and obviously that's now being called into question.
Yeah, that's what I wanted to ask you about, Michael, because when you look at it on paper, how insulated or not insulated are U.S. investors typically from what is happening in China?
Usually, it does not have a very direct or dramatic link, what's going on there versus here. Now, the issue is that it's not so much that U.S. companies are very dependent on exports to China or even business domestically there, but because the rest of the world is growing so slowly, and you're seeing things like oil prices and other commodities collapse because the demand from the emerging markets, including China, has been much weaker than expected. All those things do create complications in a stock market that was priced for further growth, that was priced for a pretty good environment, which by that I mean, the U.S. market is reflected in the Dow. And so that's the adjustment going on. We went from an environment where stock prices did not really respond much to the changes in underlying economic conditions globally to one where prices are adjusting far more than the actual picture has changed over there. So it's not so much that we have to worry terribly much about growth in China for our day-to-day economic fortunes, but for the financial markets, they were leaning too heavily on the idea that the Chinese slowdown would remain modest and contained.
Michael, let's talk about something you pointed out in the earlier part of your discussion, which is that this is, by all extents, looks to be a correction that is happening between the exchanges. Let's talk about the fundamentals of the U.S. economy. Let's talk about the fundamentals of the companies that have been driving growth in the U.S. economy. Technology sector, for example, although it might make it harder for Apple and some of these other tech companies to sell their goods abroad, especially in China, as the yuan has devalued. What are the fundamentals like for companies in the United States right now?
They're relatively good in the sense that they have lots of cash. The earnings are close to a record high, and they've basically done a decent job in the last several years of keeping their finances in pretty good shape. The problem is we're a good 6 years into this profit cycle where they've been, growing their earnings for this period of time, and they're having a struggle in trying to add to it. So when profit margins are already high, these big companies don't really have another place to look. So they can be healthy, but still not be worth as much to investors because they just can't find the growth. And that's been the struggle. We've gotten to this point in the economy where growth has been modest. It has not really gathered a lot of momentum. And now we're seeing, at this point right now, this is a full-on flight from risk. You see the Dow down 1,000 points at this point at the open, down 6%. This is definitely developing into at least a kind of a mini crash scenario over the last 3 days. And that's not really about a sober evaluation of what big U.S. companies are worth. This is about people saying, I don't want this piece of paper called a stock, give me cash instead. So I think we have to say, ultimately, when prices of good businesses go down, the stocks become less risky, not more risky on a long-term basis because the businesses haven't changed nearly as much as the stock prices have.
Michael, can you just define the term correction? When you and other analysts talk about a correction in the markets, that there was a long overdue correction in the markets, what specifically are you talking about percentage-wise? Can you just shed some light on that? And also, how long typically have corrections lasted in the past?
Well, unfortunately, this word correction has become so much more specific in its usage than it used to be. But now, these days, people, for some reason, consider 10% to be a market correction. And the origin of that term is just, if you looked at a chart and you saw a chart that was kind of going steeply upward and it started to accelerate past its long-term trend, a correction would be prices that went down relatively quickly to go back to that trend. So it corrected an overshoot in the market. Now, that's become really shorthand for about a 10% decline. We've had usually, on average, since World War II, like more than one of these per year on average. But in more recent cycles, it's been a couple of years between corrections, and we had gone a long period of time. If it's just a correction, if it's just going to be one of these quick pullbacks to a trend that still remains intact, usually they don't last very long, or a matter of months, let's say. If it does turn into be something of a more prolonged downturn, something that you would then start calling perhaps a bear market, if it got to be more than 20%, they can last multiple months. It really does depend, though, at that point, is if we're talking about, a recession situation, which I really don't think is the case, or if it's just one of these quick financial panics, like, for example, we saw in 1998 and 2011.
Michael, for investors that are looking at this, and they're seeing the market down 836 points as we speak right now, down 5%, they're wondering, what should I do? And the advice that most financial advisors that I've spoken to is absolutely nothing at this point, because we don't know if it's going to drop any further. We don't know if in a couple of days it'll come roaring back. Certainly getting out at this level for people that are looking at their portfolios as perhaps vehicles to their retirement or vehicles to fund their child's education. That is good advice, is it not?
That's right. No, nothing should particularly change about what you hold. If it was for a multi-year period, if it was for a long-term goal, which is what stocks are for, by the way. They're not for money I might need tomorrow. And so, yes, if that's the context in which you own them, then you probably shouldn't do very much. If you've been overrepresented in stocks, if you feel like you're uncomfortable with where you've been and you've owned too much, guess what? The market just said you own less of it now in dollar terms. And so maybe that's brought it back into line. If you haven't owned enough, in other words, if you've been waiting and waiting and waiting to get that stock percentage up in your portfolio, then these are the kinds of opportunities that if you want to hold something for multiple years, that it's a better shot now than it was a couple of weeks ago.